Good afternoon. My name is Melissa, and I would like to welcome you to the Eversheds Sutherland webcast, What is a SPAC? I'm joined today by Eversheds Sutherland attorneys Cynthia Krus and Vlad Bulkin. We'll start with a few housekeeping notes. If you have any questions during the webcast, please submit them via the Ask a Question text box on your viewing console. After the presentation, if you would like to request a copy of the slide deck, please contact any of the speakers. The webcast is being recorded and the final version will be posted to www.publiclytradedprivateequity.com within the next few days. CLE credit is approved for this webcast in California, Georgia, New York, and Texas. CLE credit is pending in Illinois and Virginia. Reciprocal CLE credit may be available to the attendees licensed outside these states. Please check with your respective state bars for confirmation. If you would like to receive CLE credit for this webinar, please download the CLE sign-in sheet and evaluation form from your viewing console and follow the instructions for submission. And now I will turn the presentation over to Cynthia Krus, Executive Partner at Eversheds Sutherland.
Good afternoon, everybody, and welcome. So today we're going to talk about SPACs. What is a SPAC? So my name is Cynthia Krus, and I'm joined with Vlad Bulkin. We're both in the capital markets group, and one of the reasons we decided to do this webinar was because we've been getting a lot of questions from a variety of our clients or prospective clients about what is specifically a SPAC. First, we're going to talk about the market, then we're going to talk about the structure, and then the IPO process, and a little bit about the business combination. During the presentation, I will be announcing a code that you can write down for your CLE credit. So just to give you a little information about the current market and what's been happening, why we're talking about it today, there was a number of SPACs that were done 10, 15 years ago. The popularity of them had grown quite a bit until around 2007. About 66 got done in 2007 for $12 billion. That was obviously a significant growth and kind of a bulge in the market. But then once we hit 2009, there was only one SPAC that was done. So no one was sure whether that basically the market was going to ever come back. What I can tell you today is it's come back strong, and it's basically gaining momentum. Really, this type of product has been maturing over the past couple of years. And if you look at 2017 on the slide that we presented, there were 34 SPACs, which represents a fairly significant amount of IPO activity, and $10 billion was raised. So not only are the numbers growing, but also you've got the size. And I would tell you the reason that we're really talking about this today is because of the size. When you got into 2012, 2013, you were talking about transactions that were, north of 150 million. And as a result of that, you've got basically a much larger group of investment banks, founders, private equity firms that are all interested in this type of a structure. And if you look at 2017, the average size was about almost 300 million. And that's a pretty good size for an initial IPO. And if you look over to the side of that slide, you've got really large transactions where people have raised, $600 to $1 billion. If you would have asked me if that would have occurred when I first started working on SPACs, I would have said that would have never happened. And what I can say is for 2018, there's already been 4 SPACs filed, and their average size is about 250 million. So I think the momentum is continuing, and we're expecting that to keep going for 2018. If you go on to the next slide, though, what I would say is not every SPAC that gets raised is actually successful. Out of the 280 that have been raised, only about 150 have actually accomplished transactions. So there is a fair number that don't actually go out and find a business and move forward. So it is a little bit of a risky proposition, and the actual transaction is fairly structured, and you really do have to have a concentrated effort on how you're going to accomplish the SPAC. It's not for the faint of heart, and we'll keep coming back to that and some of the challenges that you have. So, Vlad, we're going to move into the discussion about the structure. Maybe you can just explain to me what is a SPAC?
Sure. Thank you, Cynthia. SPAC is a special purpose acquisition company. It's basically a business entity that's formed to, in the future, acquire a target. It's initially a shell company that comes to market, and all it does is raise proceeds and puts those proceeds in a trust account, which we'll get into, to hold until there's a target to acquire.
So what do you mean by shell?
By shell, I mean it doesn't have any operations, it doesn't do anything except it raises the money and it puts it into a trust account, and then management goes out and seeks a target.
And it usually sits there with that that money that the investors can see for about a couple of years?
Typically, the standard is you have about 2 years. These days, that's the standard to complete the business combination. So yes, it does sit in there either until the business combination is completed or the SPAC is liquidated if a combination is not possible.
That sounds a lot like a blank check company to me. How does this, is it a blank check company?
It's essentially a blank check company, but blank check companies have a special definition in the rules, and a blank check company is basically only $5 million and less in assets. And as you've mentioned, the SPACs these days are hundreds of millions of dollars. So technically, they're not a blank check company, but you can call them that.
So when the SPACs were put together, because they're very similar to a blank check, they adopted some of the requirements or similar requirements to blank checks, even though the SEC rule doesn't necessarily apply to them?
Yes, exactly. They've adopted a lot of the requirements. For example, they're required to hold at least 90% of their net proceeds from the IPO in an escrow, which is basically in that trust account I mentioned. The fair value of the targeted business must represent at least 80% of the amount of money held in the trust account. And they also issue units similar to the way a blank check company would issue, but there are some differences. For example, their units can trade, whereas a blank check company's units can't trade until the combination is completed. And some other differences we'll get into as we go on in this presentation.
Yeah, so let's talk in a little more detail just about the structure, because I think that is one of the biggest distinctions when you're raising the initial IPO. So you've got an escrow, you've got to put the proceeds, and how much of that do you have to put in an escrow and keep there?
Well, it really depends on what your organizational documents require, but the standard, actually the standard these days is actually to put 100%, if not more than 100%, and we'll get into how that more comes about, but it's 100% and it's held in escrow.
Well, do I just leave it in cash?
Usually it's invested in treasuries or money market accounts, things like that.
And so you've got the escrow. You're going to be investing in basically the types of things that wouldn't make you an investment company, right? I mean, you've got to be careful to stay out from under that.
Yes, exactly. As you know, if you invest a certain amount of your assets in securities, you can become an investment company. So you really need to stay in cash or what's known as cash equivalents, which are government kind of securities.
And who gets the interest on that?
Usually the interest can be used for operating expenses, or it can be just continued to be held in escrow and accumulated until you either liquidate or you pay for the combination.
So the investors can get that.
Yeah. Some of it can be used to run the shell company.
And what was the amount you have to invest? Is that a requirement? Is that more of a market? I think you mentioned 80% of the trust has to.
So it's the requirement. I think that's a market standard, but it's 80% of the fair value of what's in the trust has to be the fair value of the target. It doesn't mean you have to invest all that money, and as we'll discuss a little bit later, you can use cash or stock and even leverage to make the acquisition.
So and then just a little more kind of comparison. I think you mentioned that the basically a blank check company doesn't trade, but a SPAC can. Maybe you could talk a little bit about that and the type of units that might be offered.
Sure. So the SPAC usually offers units, which consist of stock and warrants. And as we'll get into a little bit later, initially the units trade. They can trade from the day of the IPO, and then they split up after a certain period of time into warrants and stock.
Right. So let's. So that's a little bit of the comparison. Let's talk now a little. Drill a little bit deeper into the structure. So what's here for the sponsors or the founders?
Well, so the sponsors or the founders usually put in a very minimal amount of money to start the company, and their potential is to eventually own 20 to 25% of the company as a reward for their work of completing the combination.
Right, but we mentioned that this isn't really an operating company, so they can't get paid for basically working on the SPAC until after the
Correct. Yes, they don't receive any salary or any other compensation. Typically, their sole compensation is from the success of the combination.
So you got founders or a sponsor group, and then you've got a brand new company. Are the underwriters really involved in basically bringing this together and bringing it to market?
Yes, it's actually typical for the underwriters to guide the management team on structuring the various features of the SPAC and advising them on what's market and what's not. And they often will take a smaller underwriting fee for the IPO and then have a potential to receive an additional fee for advising on the combination. And we've even seen some underwriters invest in the shares alongside the founders in the concurrent private placement of the IPO.
So who might be this founder group or sponsors, or what have we seen?
So it's very popular for private equity shops and other asset managers to get into the SPAC space. It's just another avenue of deploying their capital and potentially getting great returns. We've also seen corporate executives that may have been high up at another company and they have specific industry expertise, and they might go out and pursue a SPAC using their knowledge and skills to acquire a target in their area of expertise. We've seen anyone from congressmen, senators, corporate executives from Apple, Facebook, football coaches.
Right, so it's been the kind of the whole universe there. So you've got a group of people who might have market knowledge, but they may not be the operators, and you may have operators who are trying to find a new company or a new industry to get into, right? So,
yes.
So you've got to be smart about what you're trying to sell, right?
Yes. And sometimes they team up, and they might have an executive who's experienced in some particular area, and he's backed by some kind of fund.
Great. So we talked a little bit about the units, but explain a little bit more detail about the securities, because it's more complex than a normal IPO. You've got a common and a warrant. So maybe go into some of those terms.
Sure. So the units are composed of common stock and a warrant that allows you to purchase common stock in the future at a predetermined price. The units are typically sold at $10 per share. That's sort of been just the market standard. And they usually trade on their own, the units, that is, for the market is 52 days. And then if the SPAC files an 8K with audited financial statements for the SPAC, then the warrants and shares and units split up, and all three of them trade separately. And usually the warrants are not exercisable until after the business combination is completed. So, there's a lot of motivation to get the combination done. And they're usually priced above the $10 per unit, so that you only get this opportunity to exercise them if the stock appreciates.
Right, so you're talking about a $10 investment per unit, and then the warrant is exercisable at what, 115 to 120% of the total unit, and really, so really the play here is that appreciation when you find this operating company or business that you want to buy. That's really the real point or the structure here, right?
Yes, exactly. Yes.
So going on to the trust account, if that wasn't complex enough, what are some of the terms that we've seen when you're talking about putting together the trust or escrow account?
Yeah, so usually you need to put, pretty much 100% of the proceeds into the trust account, and it can't be used for much other than to hold until you have a target. And, as I said, you can invest it in treasuries and money market funds. Sometimes there are variations on underwriting fees and how much will be, extracted from the proceeds and put into the trust, or how much is not. So sometimes there are variations on that. But oftentimes, if you need money to run the company, that can come from an investment that the founders make in warrants.
Right, or if you've got a raise and that raise may go through the IPO, 100% could go into the escrow. We said 90%, but that's kind of been moving up a little bit over time. If you needed money to operate, you could basically get that through a private placement to founders, right? So that
yes.
So they're really fronting the that period of time. So you need to know how much you're going to need to pay out from taxes or operating or working capital purposes for that short period, which would involve all the requirements for being a public company during that period.
Exactly. Yeah.
So if you're looking at trying to put together an agreement for this escrow account, what happens? Should you be worried about the liability that might attach? Should you look for a waiver?
Yes, you want to make sure the trust account is protected, and so that people can't make claims on the money that's in the trust account, and they waive any right to that money while that,
While it's in there.
While it's in there.
Great. And then what are some of the other optional features that you may have seen? I mean, what I can say is that this market has, or product has morphed over time, and when somebody puts a feature in one of these structures, it usually gets picked up from others because the market knows they can get it. So what are some of those other features that you might see crop up?
Definitely. So there's usually lockup agreements on the founder shares, and they might also have registration rights for their warrants and things like that. There's also the redemption right for shareholders, so if they don't want to continue with their investment in the SPAC after the combination, they might have an opportunity to redeem their shares for the money that's in the trust account for their pro rata portion. Oftentimes you see also an obligation on the sponsor to commit to an open market purchase plan at the time of the combination to show that they're still committed to the combination and they're putting more money into the company as part of the combination.
Well, in this context also, I mean, isn't the goal here is to get to a shareholder vote that will be approved to buy this elusive company we've been talking about?
Yeah.
Are there any protections that you can put in place for that purpose?
Yes, definitely. So one of the protections that's available is to
you can basically have a provision that allows you to vote for the business combination, but you still get your money back, so you don't have to keep yourself tied up.
Yeah, exactly. And then, as we'll get into a little later, there are other provisions that limit on shareholders' ability to convert into the money that's in the trust account.
Well, let's talk for 1 minute just on what's the motivation behind the sponsors, founders? What do they get out of this from a kind of a monetary or economic standpoint?
Yeah, I mean, so they can put in a small amount of money and have the potential to multiply that money by 8 to 10 times easily, to put it simply. So they usually put in maybe $25,000 to buy 10 million shares of stock at par, and then they also, if their money is needed to run operations, they might buy warrants, say $7–10 million, and then as the combination gets completed, their shares become worth about 20% of the combined company, and then at that time, you know, let's say it's a $500 million company, you suddenly own 20% of it for that $10 million you put in.
Right. So there, I mean, this is really at-risk capital, right? This is the context here is that if a acquisition never gets accomplished, that money is no longer doesn't get necessarily given back, or it's used for the operations during that period, and then you've got the upside of the 20 to 25%. Maybe you can. We've got a sample of a kind of the deal flow. Maybe you could just walk us through a little more detail on that.
Yeah, sure. So this is just a sample chart to show how initially the founders invest $20,000 in 10,000 shares of stock, and they also invest in some warrants at the time that the IPO is completed. So as you can see, that the IPO raises $400 million for 40,000 units, and then the founders acquire 20 million units for $10 million. That's really the big check that they write for their part. And then once the combination is approved and it's completed, suddenly the founders own, you know, 20 to 25% of the company, depending on if the warrants convert. And, you know, for all their effort, this is really their reward of owning 20 to 25% of a company that's worth about $400 million.
Not bad for a day's work.
Not bad. Well, it's not a day's work. It's about 2 years of work.
So, good correction. So what type of companies, I mean, we're talking about operating companies for the most part, although we could get into a little more detail about that, but what kind of companies do SPACs generally look at?
So it really varies depending on the founder's expertise. Sometimes they'll go out and looking for a specific industry, like energy, healthcare, technology, real estate, and sometimes they'll just say, we'll do something broad, we're not sure yet. Sometimes they'll focus on a specific geography. Recently we saw a SPAC filed for, they want to focus on a Latin American company. And as you can see, the variety of SPACs that have been completed is all over the map. Clothing, food, energy, there's been a lot of those.
How do you advise somebody if they're coming to you, they want to do a SPAC on whether they should go with an industry or product area?
Well, you assess what their skills are and expertise and what they can market, and that's what they should focus on.
Wasn't there a SPAC recently that was a unicorn?
Well, it's focusing on potentially acquiring a unicorn. It hasn't completed the combination yet, but there was a SPAC in September that raised a lot of money, I think almost $700 million, and by a former executive of Facebook, and he's focusing on acquiring a technology company, probably one of the many unicorns that are out there in Silicon Valley.
One of the areas I thought was interesting is the cannabis SPAC. Isn't there one that's out there doing that today?
Potentially, yes, I think so, yes. But that's just everywhere in the market now. Everybody's interested either in cannabis or Bitcoin.
It'll be interesting if that one comes to fruition, or if there's other legal issues that crop up as a result of that. I just want to pause for a second now to provide you the CLE confirmation code, which is we're very unique SPAC IPO. Anyway, so back to our program. Let's talk for a minute about the business combinations. We're talking about the 80%. Talk a little bit about the time frame, the vote, that type of thing.
Yep. So as I mentioned, the market value of the target has to be at least 80% of the funds that are in trust account. And because of the strict deadlines that SPACs self-impose on themselves to complete the combination, it can become stressful to meet that deadline with the 80% parameter. And there have been situations, even as recently as in December, where you seek a shareholder vote to extend the deadline.
Yeah, and there was a number of those that happened in the kind of the 2007 to 8 period of time when people had raised some of those SPACs, right? So that there is a way to get an extension, but it's not necessarily cheap, because you also have to go out and get the vote and get your shareholders to buy into that additional time frame. I mean, 18 to 24 months sounds like plenty of time.
It's really not, because you have to negotiate a merger. You have to go through the entire SEC review process for a proxy, a shareholder vote, completion of the closing. You can easily run up against that timeline before you know it.
So what? Explain to me some of the discussions about conversion rights.
Yeah. So one of the typical rights that's given in a SPAC is that not only do shareholders have the right to vote on the combination, but they also have a right to opt out and convert their shares into an interest in the trust. So basically get their money back, or at least whatever their proportionate share is in the trust. And one of the requirements is that if a certain percentage of shareholders decide to convert the money in the trust, even if the combination is approved by a majority of stockholders, and let's say majority approve the combination, but then either 20 or 30%, whatever the threshold is, decide to convert, that kills the whole deal, and the SPAC still has to liquidate. So there's a strong interest not to convert, well, at least from management side, to convince shareholders not to convert.
So just a little more detail on the charter conversion limitations that people have started out.
Right. So because of this conversion feature, hedge funds have found a way to take advantage of it and kind of use it as a tool to threaten management teams to buy back their stock at a premium. So if they acquire a big block of stock and then they might go to management and they see that they're on the heels of getting a combination done, they might say, we'll vote for the conversion if you don't buy it back from us. So in retaliation to that, certain SPACs have put into their governing documents a mechanism whereby it limits how much of your stock the shareholder can vote to convert. Even though if the fund is SPAC is liquidated and money is given back to everybody, they'll get all their proportionate back, but they might not be able to vote for the conversion with regard to all their shares.
So really, at the end of the day, I mean, there's been some struggle around SPACs and the trading and the arbitrage, and this is a little bit to dampen some of that.
Exactly, yes.
So let's talk about the actual IPO process and focusing on some of the differences when you're dealing with a SPAC. I mean, the process begins with the filing of a registration statement. You have to file a listing application, and then you have to get through the FINRA requirements as well. So let's take each one of those steps and talk through, what are the issues or challenges around the S1 filing?
Sure. So one of the good things is that SPACs are eligible to be emerging growth companies. So since 2012, when that became available, they've been able to file confidentially and have their registration statement, reviewed in advance before becoming public. But it's really a standard IPO process for any other operating company. They file an S1 registration statement, assigned to a specific division in the Division of Corporation Finance, and they typically take 30 days to review it. They give you comments. You might have several rounds of comments, and then you start your roadshow and get effective.
Right. So there's no, since these are not blank checks, and you're not at the state process, there's really no merit-based type review here, right? This is a standard disclosure.
It's a standard disclosure review.
And since you don't have a company, you don't have some of the issues around getting audits of the underlying company at this point, at least.
Exactly. Yes.
I mean, that's one of the benefits of I think, the SPAC, because if you raise the money, you don't have to wait till you can get a full-blown audit or necessarily have that company 100% up and IPO ready. Maybe you can just talk a little bit about how would you, does the SEC look at whether you've actually gone out to approach, a target?
So that's one of the things that you really need to be careful about. You don't want to have any conversations or any contacts with any targets until the SPAC has completed the IPO. Otherwise, you could be viewed as really bringing that company to market, and then you really are just doing an IPO for that target company, and the disclosure would need to be all about the target company. So you really need to be very careful not to have any contacts with any targets.
And the SEC, in comment letters, they've spent a fair bit of time asking you whether you have, especially if you're an industry executive, if you've been talking to your
Exactly.
friends about who you're going to look at or what kind of companies you're going to look at. So you can't try and shorten up your calendar by going out and get those ready, right? So that's just not allowed, and the SEC will ferret it out if you do.
Exactly. Yes.
You also have to be careful about whether there's any conflicts. You can't really be talking to people about combinations, meaning or compensation they might get or that type of thing. You got to be really pristine. Right.
Yes.
So just to talk for a minute about we talked about the fact that the shares trade. What market are we on, or what are we on? Nasdaq? Are we OTC or New York Stock Exchange?
So 10, 15 years ago, more like 15, 20 maybe, SPACs used to really only be on the OTC, and they had to deal with a lot of issues relating to blue sky compliance, things like that. These days, especially the big SPACs, they're all on either Nasdaq or the NYSE. About 10 or 15 years ago, Nasdaq and NYSE amended their rules to allow SPAC listings, and they've continuously been lightening their rules to really accommodate SPAC listings and just really aggressively targeting SPACs to list on their exchanges.
Right. So the time when you had to go to each state to get that merit-based review doesn't exist really anymore. I mean, you're generally on one of these exchanges.
Right.
And so let's talk a little bit about the exchange itself. I mean, are both New York Stock Exchange and the Nasdaq the same right now?
They're very comparable. Right now, for example, the initial listing requirement is to have 300 round lot shareholders. A round lot meaning you own at least 100 shares, and they have comparable governance requirements, and they both require that the combination be completed in 36 months. Although, as we mentioned, the governance documents of the SPAC usually are less than that. So you
got to be careful for both those things.
Yeah,
right? You got to make sure you meet all those requirements.
Exactly. And right now, actually, Nasdaq and the NYSE are seeking to lower their listing thresholds to 150 round lot shareholders. They're arguing that SPACs don't have as much volatility in their trading, and they don't need as many different shareholders to keep the stock trading at a stable price.
And those rules will go on to talk about what the shareholder approval requirement is, which might be different than your governing documents or your state of incorporation. So you got to make sure you have all of those in place. And one of the things I think we want to focus on a little bit is just that Vlad mentioned the governance requirements. You're truly a public reporting company, and all the things that apply to a public reporting company here apply to the SPAC even before you find a company.
Exactly, yeah. From day one, as soon as your IPO is completed, you really need to be complying with Nasdaq or NYSE listing requirements, and you do get some relief as an emerging growth company, but it's like any other operating company.
So let's talk a little bit about the FINRA process. That used to be actually a fairly significant process. It used to have a number of companies. I think everybody saw on the front pages that you got the Citigroup, and you got Goldman, and you got Credit Suisse, those types of bankers. But in the early days, that wasn't necessarily the case. You might have had smaller investment banks, and it might have taken a little bit more effort. And how people were being compensated, I think, was something FINRA really talked about.
Yeah, so the FINRA process, and kind of like the SEC process, is like for any operating company. FINRA wants to make sure that the compensation to the underwriters is fair and equitable. So they need all the information that's going to be paid to the underwriters, and usually it's also disclosed in the registration statement. And as I mentioned, there are structures where underwriters get paid later for their combination work, or they might buy shares. FINRA will want to look at all of that to make sure that the whole package is fair and equitable.
Right, so you're talking about cash and non-cash.
Right.
Everything needs to be included and live within the limits. And there were some rules that were passed in 2008 that pretty much govern all that, all those requirements. So we talked a little bit about the listing requirements. What about the reporting requirements?
Again, like any other operating company, from day one, the SPAC has to comply with the 34 Act, filing 10Ks, 10Qs, 8Ks, any proxy statements and needs to solicit shareholder votes. Directors and officers are subject to Section 16 reporting. When you file your reports, you have to give the standard SOX certifications. Again, you have to comply with the listing requirements. One of the benefits of being an emerging growth company, you don't have to get an audit on your internal controls over financial reporting for 5 years, but otherwise it's pretty standard like any other operating company that might IPO.
And you must have what I call poof IPO, where you've got all these requirements, and these are not for the faint of heart. You've got to file on the timelines. You've got to have your audit committee and your board put in place. So all of these things have to come together, and they come immediately. In addition, you have basically an investor base because you're publicly listed. So you've got to make sure you've got all these covered, or you have somebody who does that for you. What are some of the operating concerns along those lines?
Well, as you've mentioned, you want to make sure that whatever you're holding in your trust account is not being invested in securities that would cause you to be deemed to be an investment company, because otherwise you'd then have to comply with the 1940 Act, and as we all know, that's a whole other slew of regulation.
That's a whole other webinar.
Then you have to actively find a good candidate to acquire, and that might not be easy in the time frame. And just balancing all this regulation and reporting requirements and making sure that the money that's in the trust account is not touched until the combination or liquidation.
So and we haven't even gotten to finding the company yet.
Yes.
So let's talk about some of the challenges or vagaries around finding that target business. I mean, you're not the only one out there looking for a business that you want to acquire. I mean, you've got private equity funds, you've got LBO funds, you've got just strategic transactions going on. What how do you search for this? How do you basically meet your time frame to get this?
Well, you use your contacts in the industry that you've hopefully had and that you use to pitch the whole SPAC. You have to conduct due diligence. It's pretty typical to be talking to multiple targets at the same time so that...
I mean, you're doing diligence on several
Yes.
potential companies you might want to acquire?
Yes, because you never know what might happen, and you're kind of on this specific timeline, so you have to be, diversifying.
Could you even imagine if you, because we've talked about acquiring one business, so this is, you could argue this is a one-time wonder. You could technically buy two if your documents allow, but you'd have to get both of those ready to close simultaneously.
Yes, you'd have to run two processes at the same time, diligence, negotiating merger agreements, seeking shareholder votes to approve the combination, which requires also, again, an entire proxy process. If you're paying for the target with stock, you might need a registration statement to register those securities. Dealing, as we mentioned, with the people who want to convert instead of approving the combination. It's certainly not an easy process.
Right, so let's talk about a little bit about the negotiations. In this context, you've got you've got a sponsor group or founder group who's got a timeline that they've got to meet, and then you've got targets who they're going to. Are all the same requirements? I mean, is the target the same place it would be in a normal transaction, and acquirer?
No, I think typically an acquirer has more leverage and can push the target around a little bit, but given this timeline that the target obviously knows about, they can push back, and actually they typically have the leverage and can negotiate better pricing, better terms, and it's kind of a reverse of what you would typically expect in an M&A transaction.
Right. So, I mean, one of the things that the guidance we would give is the sooner you can find something, the better off you're going to be from that negotiating position. So, just looking at it, if it takes you a couple months to basically get out there, get your LOIs, say 2 months or so to do that, and then you actually negotiate, do the diligence, negotiate. You're talking about another 2 or 3 months. You're talking about being 6 months in, and you still haven't even filed anything at the SEC. So let's say you're at 6 months and you got to go to the SEC and you're going to do a couple rounds because you got a company. Remember, these are generally, well, some of them are larger, but some of them are private, which means you've got to basically get their financial statements up to speed for the SEC. You could easily get into a year or so, 9 months to a year before you've taken a vote. So, and what if it fails? I mean, then you've only got a short period to go back out, and so it really is something that you've got to spend a great deal of time dealing with and making sure how you're going to process this, who's going to process it for you, who's going to manage the entity during the period of time that you're looking for the business combination, and what type of business combination you're looking for. Because it may be faster to go out and raise the money in this context, but this back end is really important to make sure you've got that in under your belt as well. So maybe you can just spend a minute or two talking about, just to summarize, some of the advantages and disadvantages of a SPAC to a sponsor or investor.
Sure. Not to, end on a gloomy note. So we'll just, for a sponsor, again, this is a great opportunity to acquire a significant part of a company for a relatively low cost. So it's low cost of capital, and then there's, going forward, access to capital in the capital markets. For an investor, they get to invest in a private equity type of transaction in a public vehicle, plus they have all the protections of having their money set in a trust, and there's the potential upside with the warrants, and they can always convert into the trust interest and get out. So almost like a no-lose situation for investors. And then for the target, if they're ready to be a public company, it's usually less onerous than doing their own IPO, and they might be able to negotiate better terms with the SPAC. And then they're, it comes with brand recognition, everything that comes with being a public company. You have access to greater capital markets.
Great. Okay, well, we're going to take a couple of questions. We got a little more time this afternoon. One of the things I'll say is that if you'd like a copy of the slides from today's presentation, if you want to contact myself or Vlad for those, we'd be happy to provide those. The questions that we've gotten so far, one was whether basically a target could be an asset manager or a REIT. And so an asset manager generally, depending on the balance sheet and the 40 Act analysis, is an operating company. So you likely could go after an asset manager. I don't know off the top of my head whether that's been done before. As far as a REIT, I think that would be a little more complex, although I don't see why you couldn't. But you generally would have to make sure you would get the tax advantages for that. So I think it would be a little more complex, and the 40 Act analysis would be a little more detailed. So I believe that it likely could be done, but it's, again, more structure. And one of the things here is that you'll see a number of names come up, and people who've done these before. Making sure that you've got people who understand this product is really one of the things that you want to focus on if you're interested in working on these. Another question, which is a little more technical, is that can you explain why some SPACs file an 8K that has the audit balance sheet for the IPO? And I believe that reasoning is effectively to stay out from under the blank check rules. And so that's you've got to have basically a company that's got money in order to do that. And then another one, which may very well be somewhat in my what we've seen as far as legal fees that are attached to at least the initial IPO, and some of the recent ones that have been filed are anywhere from kind of a 200 to 300K, depending on the sizing. That really goes to just the agreements between the parties. So all I want to do is mention there that that's what we've seen on the filings, certainly not mentioning anything about what we would do in that context. So I think that those are all of the questions that we've got. I don't know, we'll wait a minute more and see if anybody has anything else. Otherwise, we can bring everything to a close. Looks like that's it, unless somebody's typing really fast. Anyway, so thank you everybody for joining us. Reminder that there is CLE credit. You can go in and get a download of the sign-up sheet through the program that we're on. If you have any other questions, obviously contact myself or Vlad, or obviously you can go and listen to this presentation, as was mentioned earlier on, through the publicly traded privateequity.com. So thank you for joining us. Hope this was helpful. Talk to you soon.
Thank you. This concludes today's teleconference. You may disconnect your lines at this time. Thank you for your participation.